Hello traders, and welcome back to Explain the Charts. Today is November 3rd, 2025, and we're taking a deep dive into the NZDUSD, also known as the Kiwi. We'll be breaking down the latest news influencing this pair, and then jumping into a detailed technical analysis across multiple timeframes. First, let's look at the macroeconomic picture, because it's setting a very clear tone for this currency pair. Recent headlines are overwhelmingly pointing towards a strengthening bearish bias for the Kiwi. This is largely being driven by a hawkish tone from the U.S. Federal Reserve, with Chairman Powell casting doubt on further rate cuts, which has significantly strengthened the U.S. dollar across the board. This dollar strength puts direct downward pressure on pairs like the NZDUSD. Compounding this pressure is the anticipation of crucial New Zealand labour market data for the September quarter, which is a key factor for the Reserve Bank of New Zealand's policy decisions. The market is currently pricing in a high probability of further rate cuts from the RBNZ, especially if this upcoming labour data shows continued weakness. Analysts are noting that the Kiwi's correlation with cyclical assets, like the Chinese yuan and dairy prices, is also contributing to its weakness in this risk-averse environment. So, the fundamental picture is quite clear. A strong US dollar driven by a hawkish Fed, coupled with a potentially dovish RBNZ awaiting weak domestic data, creates a strong headwind for NZDUSD. Now, let's see how this fundamental story is playing out on the charts. Looking at the daily chart, the long-term trend is undeniably bearish. After peaking back in late September around the 0.635 level, the price has been in a steep decline. This downtrend confirms the narrative of a strengthening US dollar and a weakening New Zealand dollar. The news specifically mentioned a rejection at the 0.5800 resistance level, and we can see that clearly here. This 0.5800 mark acted as a ceiling in late October, and the failure to break above it triggered another significant leg down, reinforcing its importance as a key resistance zone. The price has since fallen to the low 0.57s, confirming that sellers are firmly in control. What's particularly striking on this daily chart are the massive downside wicks we saw in November. Look at these candles on November 8th, 15th, and 29th. They show moments of extreme volatility and capitulation, with prices momentarily crashing below 0.55 and even towards 0.50. While these flash crashes recovered quickly, the sheer size of these wicks indicates intense selling pressure lurking beneath the surface. These events completely wiped out any minor rallies, showing the fragility of any bullish momentum. Let's zoom in on the price action since that September peak to get a clearer view of this downtrend. Here we can see a classic series of lower highs and lower lows. The price broke through several support levels, including the psychological 0.6000 mark, which is now acting as a distant resistance. The news highlighted a shooting star pattern on the weekly charts and a bearish break of a rising wedge on the daily, both of which are classic reversal signals that have clearly played out. The October low, noted in reports to be around 0.5683, is a critical support level to watch. Our chart shows a low of 0.56793 on October 7th, which aligns perfectly with this analysis. A break below this level would open the door for a much deeper correction. The momentum is clearly to the downside, with each rally attempt being sold into aggressively. Now, to understand the immediate short-term sentiment, let's switch to the 15-minute chart. This gives us a granular look at the price action over the last few trading days. As we can see, since the rejection from the 0.5800 area, the price has been in a choppy, downward channel. The action has been contained between roughly 0.578 on the upside and 0.572 on the downside. This suggests a period of consolidation after the recent sharp moves. However, the pressure remains on the downside, with bounces being shallow and failing to reclaim higher levels. Sellers are stepping in every time the price attempts to rally, which is typical behavior in a strong downtrend. This short-term price action reinforces the bearish bias we see on the higher timeframes. Traders are likely waiting for the next catalyst, which could be the upcoming New Zealand labour data, before committing to a larger move. So, let's bring it all together and switch back to the daily chart for our final summary and outlook. The fundamental and technical pictures are strongly aligned, painting a bearish outlook for the NZDUSD. Let's recap the critical price levels you need to be watching. On the upside, immediate resistance is at the 0.5755 level, followed by the major psychological and technical barrier at 0.5800. A convincing break and close back above 0.5800 would be required to neutralize the immediate bearish pressure, but that seems unlikely without a significant fundamental shift. On the downside, initial support lies around the current lows near 0.5710. If that level breaks, the next major target for sellers will be the October low around 0.5680. A failure to hold this level could lead to a swift move down towards the 0.5640 support mentioned in the reports. Given the context, the bearish scenario seems most probable, with about a 75% likelihood of retesting the 0.5680 lows in the coming weeks, especially if NZ labor data comes in weak. The bullish case, a break above 0.5800, feels like a lower probability event, perhaps around 25%, and would need a surprisingly strong NZ data print or a sudden dovish pivot from the US Fed. The key event to watch for is the RBNZ's final meeting of the year on November 26th, where the labor data will heavily influence their decision. Until then, the path of least resistance appears to be lower, and selling into rallies remains the favored strategy for many market participants. That's our in-depth look at the NZDUSD. Please remember, this content is for educational and informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own thorough research before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next analysis.